Everybody, welcome to the show on June 26th, 2025. And thought it might help if I actually tell the day for everybody. And can someone explain to me how to get the stocks that Jeffrey trades? Either a link where I can check his stocks every day or the weekly newsletter with stocks to buy. I heard he's almost 100% wins. That would be great. Channel members get the list of stuff I got, and my Termite Trading Lab group, I share every trade as I do it. You can get the, if I pull this over and grab the K info link, you can see every trade I ever make right here. You heard I have 100% win rates. It's not 100% now. I did take a loss on VIX. Just saying, I did take a loss on some protection. Did take one. Here's the link right there for Erdy. And my channel members, Ivan, Jerry, Donald, Will, Hugh, Mad, Ed, Rob, Nancy, Scott, Sergio. Hey, Sergio, how's your trip going, my man? Frank, Don, Diane, Ted, Cliff. Good morning, everybody. David, Skaggs, Laura, Aki, Mary, Rod, Rungamer. Yeah, it's on K info right there. That's a posted link to mine. Hey, Gustavo. Good morning. My family's going to be coming through San Antonio again. My oldest son, my daughter, and my wife. Carmen, sometime next month, I guess. Mark, Alan, all good. There you go. Can someone send me a link? Dude, we just posted the link. I posted a link. Somebody else answered you. Yeah, here you go again. Just in case you missed it. There's the trades. They're all there. Anyway, you can become a channel member and you get them too. So sometime, hey Chris, how's it going? And so prepared yet another YouTube monologue. Let's see if I can. I just dismissed it. I need to pop it back up again. No, we don't want to install Windows updates. Not at the moment. What the heck? That would not be good. All right. So picture this. It's June 25th, 2025. Yesterday in, reality time, 7 of the most powerful people in America, in American finance, are sitting around a polished conference table in Washington, D.C., about to make a decision that could reshape how our biggest banks operate. The room is tense. The stakes couldn't be higher. The final vote is 5-2. But this isn't just another bureaucratic decision buried in financial jargon only that Wall Street insiders care about. This decision affects every single American like you, whether they realize it or not. What they voted on could either strengthen our financial system against the next crisis, or could be setting up a repeat of 2008. We have that chart pattern like 2007, right? Now, even the smartest financial minds in the country can't agree on which one it is. So let me tell you a story and about what just happened, and you can kind of make a decision which way you think it might go. So to understand the story, we need to go back to 2008. Remember that year, the housing market collapsed, Lehman Brothers went bankrupt, the entire global financial system, great financial crisis. We almost burned it all down, right? Americans lost homes, jobs, retirement savings. I mean, it was a disaster. It was rough. So in the aftermath, regulators did what regulators do. They created more rules, lots of banking rules. To try to prevent this from happening ever again, right? One of the most important one was something called the Enhanced Supplementary Leverage Ratio, or ESLR in bankers' terms for short. Now, think of it as a safety requirement for banks, like requiring firefighters to wear protective gear when they go into the fire, right? I mean, hey, it sounds pretty good, right? So here's how it works. Banks have to hold a certain amount of capital, basically their own money, against everything they own, regardless of how safe or how risky it is. A treasury bond, which is backed by the full faith and credit of the United States government, same capital requirement as a junk bond from a company that probably going to go bankrupt tomorrow. Now, a mortgage to someone with perfect credit, well, that has the same requirement as a loan to somebody with a credit score of like 150, which is about the lowest you can go. Now, you might be thinking, that seems a bit extreme, and, well, you might be right. But remember, we were traumatized in 2008, the great financial crisis. The thinking was the better safe than sorry mentality, right? Let's err on the side of more capital, not less. If banks have to hold more capital against everything, they're stronger, they're more stable. They won't be able to, take those crazy risks and blow up the entire system again, right? Well, this worked for a while, and banks became stronger, but they built up massive capital buffers, and the financial system seemingly became more stable. I think we just kicked it down the road. But something unexpected started to unfold in the background. Banks began avoiding treasury bonds. Now, this might not sound like a big deal, but it's actually kind of big. Treasury bonds are the safest investment in the world. They're backed by the US government, which has never defaulted on debt to this point. And when there's a crisis, usually everybody runs to treasury bonds for safety. Yeah, I might talk about this more tomorrow. They're like the financial equivalent of a bomb shelter. But here's the problem. Under the current rules, holding treasury bonds requires the banks to set aside the same amount of capital as holding much riskier assets that return higher amounts. So banks started thinking, why should I tie up all my capital in these super safe bonds that don't pay much money when I could use that capital for more profitable activities? It's like forcing a security guard to treat a teddy bear the same as a loaded gun. Technically, you're being extra cautious, but you're also creating some pretty wild incentives, unintended consequences, as I usually call them. Now, this created a problem in the treasury markets. During times of stress, when everybody wants to buy treasury bonds for safety, banks weren't there to help facilitate those trades. It's like having a traffic jam, discovering that all, or maybe half the traffic cops decided to stay home because their uniforms just too heavy, too burdensome. And that brings us to what happened yesterday, the most contentious Federal Reserve vote in years. So, leading the charge for the change, Jerome Powell himself. Picture Powell standing at the head of the conference table. This is what we need to do. Now, maybe we overcorrected, Powell argued. In an effort to make banks safer in 2008, maybe we created rules that are actually incentivizing financial markets to be less stable. His logic, compelling. He made a solid argument. The current leverage rule, he explained, doesn't distinguish between risk levels. And it treats bonds, treasury bonds, as the safest, these are the safest assets in the world, technically, to this point, the exactly same as a junk bond from a company that could go bankrupt at any moment. This creates what economists call perverse incentives. Think about it this way. Imagine your car insurance company charged you the same premium whether you drove a brand new Volvo, or with every safety feature, arguably one of the safest cars, or a 1970s muscle car with no airbags, questionable brakes, souped up supercharger, maybe you'd think twice about buying the Volvo, right? Same interest, same insurance rates, And a supercar, same insurance rates as Honda Civic, So that essentially is what happened with banks and treasury bonds. Powell's vision was clear. A leverage requirement functions best when it's generally a backstop to risk capital requirements. So, the risk requirements based on the risk, not just based on having an asset. So, we're seeing this kind of become binding. They discourage banks from participating in low risk, lower return activities that actually support more financial stability in the economy, like treasury market intermediation. In other words, we've made the rules so strict that banks are avoiding the very activities that help keep our financial system stable. Now, supporting Powell was Vice Chair of Supervision, Michelle Bowman, who actually spearheaded this effort. Bowman painted a picture of a more resilient financial future if we make these changes. The proposal will help build resilience in the U.S. Treasury markets, she argued, reducing the likelihood of market dysfunction. Now, her point was crucial. If banks are able to more easily hold treasury bonds during the next crisis, then hopefully the markets will function more smoothly. The Fed won't have to step in and start buying bonds themselves and keep the markets working like they did in 2020 pandemic and the 2008 crisis. Bowman called the recalibration as, sensible and timely, a fix that would restore and enhance supplementary leverage ratio rules to its original purpose, being a backstop, not the primary constraint on banking activities. But perhaps the most compelling argument from Fed Governor Christopher Waller, we see Waller talking all the time, he cut straight to the heart of the matter with a simple analogy that anybody could understand. The leverage ratio treats a treasury bond the same as a junk bond, Waller said. But we know they're not the same. Waller explained that the current rule had become binding for some banks, meaning it was the limiting factor in their decisions, not the risk-based capital requirements that were supposed to be the primary constraint. This was creating unintended consequences for bank health. As Waller continued, reworking that incentive structure to address these unintended consequences of the current recalibration kind of makes sense. So, we're seeing several of these banking Fed members kind of support this. Now, sitting across from the optimists were two Fed governors who saw the proposal very, very differently. To them, this wasn't fine-tuning, it was kind of playing with fire. Michael Barr, one of the Fed governors, he was the Fed's former top regulatory official, was a vocal opponent to this whole thing. He criticized the proposal as significantly reducing bank-level capital and potentially encouraging firms to take on more risk or return capital to give shareholders a boost rather than expanding treasury market activity. So, this is the flip side. Like, if we change these rules, maybe they actually will invest in more risky investments than they have been. He dropped numbers that made everybody sit up and pay attention. He started throwing around billion-dollar numbers, like $132 billion in long-term debt requirements. Now, we're talking about hundreds of billions of dollars in safety buffer. And I need to mute my phone here. Cool. Apparently, the headphones aren't taking over. So Barr warned that these changes could significantly increase that a bank might fail. Orderly resolution would not be possible, and the deposit FDIC would have to incur higher losses. So right now, FDIC insurance bank deposits per account up to about $250,000, and when Barr talked about it incurring higher losses, he was essentially saying that taxpayers could be on the hook if one of these bigger banks failed. Now, Barr's warning was stark. The less capital on hand, large banks would be more vulnerable in crisis. So what they're looking at doing is reducing the capital requirement for safer assets, not adjusting up the capital requirement for risky assets. So that's the long and the short of what they're thinking about doing here. And history suggests that banks will probably take on more risky assets to help benefit shareholders. That's just kind of the nature of the business. Now, as we look forward, the skeptics' case is kind of equally compelling for various reasons. They're not arguing against the change for its own sake. They're arguing that the cure might actually encourage the disease in some respects. So the debate raged on, and they actually took a vote. And it's a vote that divided the Fed 5-2, like I said. So the optimists won. The skeptics, they didn't disappear. In fact, those concerns are now part of the public record. Maybe that's how it goes down. Now, this goes out for a 60-day public comment period where banks, academics, consumer groups, anybody else who cares can weigh in. The Fed will have to consider all the comments before making a final decision. So we've got 60 days before this actually goes into effect. Now, you might be thinking this all sounds very important, and what does it actually mean for me? Fair question. And to be honest, it depends on how it turns out, right? If Powell and the team that actually won the vote is right, well, maybe it makes the system more stable, more resilient, encourages more treasury investment. Your 401k might not lose as much value in the next crisis because the Fed might not have to intervene as aggressively and the markets may not dump. Now, if the skeptics are right, the taxpayers, you, me, all of us, could be on the hook to bail out too big to fail banks, right? And maybe we don't bail out too big to fail banks. We just, backstop the FDIC insurance as banks do fail. So this whole thing really comes down to a fundamental question that goes beyond banking regulation is how do you balance safety with efficiency? After all, in 2008, the pendulum swung hard towards safety after everything kind of came apart, thinking that better safe than sorry. Now, 15 years later, we've kind of forgotten, it's not so bad anymore. And it's kind of like the difference between driving 25 miles an hour on the highway and versus driving 85 miles an hour on the highway. At 25, you're kind of unlikely to get in a serious accident that you cause. Maybe somebody else wrecks into you, but you're also creating traffic jams and road rage. And, like I said, somebody else might wreck into you. And at 85, you're moving efficiently, but one mistake can be catastrophic very quickly. I mean, fair analogy, I guess. So what's the right speed for the financial system? Well, we aren't sure, right? We haven't had any problems in 15 years, but maybe it's time. So this change could line up. Think about it. 60 days from now could line up with the time frame I've been talking about when things take a nasty turn. It's kind of weird, right? So the decisions made yesterday could affect every American for decades to come, especially if the wheels come off the train. And this proposal, if it doesn't go through, well, we might be stuck in a system that's safe, but inefficient, or possibly creating systemic problems that are unintended consequences. It's all kind of the wild thing. So what happens now? The proposal will be published to the Federal Register, and we go into a 60-day comment period. Banks likely support it because, hey, we free up capital that's not required for those safer assets that I'll talk about more tomorrow probably. And the Fed will have to, weigh in on all the comments that come in from consumer groups and academics and you if you make a comment. And all this will have to be addressed before it goes into actual rule. It's the proposed rulemaking, basically. So what I find most interesting about the whole story is it shows that even the highest levels of finance and economics, there's still a lot of human elements to these decisions. There's no clear cut. All these people, they don't actually know what's going to happen, right? They're just making guesses, and they're real people with real expertise, real convictions, are arguing to try to make the best decision with incomplete information, uncertain outcomes. We don't really know what's going to happen for sure. Jerome Powell genuinely believes that loosening these rules are going to make the financial system better. Barr genuinely believes that making the system more dangerous. They're both smart. They're both experienced. They're both well-intentioned people that have the same data and same analysis and, arguably have come up in the same markets. But they've obviously reached completely different conclusions about what this loosening of financial regulations might do. So here's my take on the whole side. Both sides have valid points. The truth is something's probably going to happen. All right. The optimists might be right. We might get some loosening. We might see more investment in treasury bonds, but are the treasury bonds actually safe? That may be a flawed assumption. We can talk more about that tomorrow. Now, the key is making sure that all this happens thoughtfully and orderly and not just rips the Band-Aid. So your voice does matter. You can comment on that 60-day period if you want to. And history is being written because we're about to change the regulations that we set in place after the last financial crisis. So there you go. That's my monologue for today. If you found any of that information interesting, beneficial, helpful, you can let me know in the comments. And so JAAA, potentially safer than the Treasury. So we're talking about things like Bill and JAAA, JBBB, and PAAA. So if I pull up charts here, this one is AAA collateralized bonds. So Treasury bonds are what they're trying to encourage purchase of. But maybe those aren't the safest thing if we're going to debase the currency, dollar, flight from the dollar, problems that, systemic problems that we've never seen before. These right here, PAAA and JAAA, these are AAA collateralized loans that we've never seen a AAA rated company ever default on a bond right here. Now, flip that around, Treasury bills, this is what they're encouraging investment in with these potential rule changes. We've not seen these ever blow out either, but as I mentioned, there may be systemic risks here. So if you need to park capital, my gut feeling right now, probably JAA or PAAA, probably the safer places. Now, that doesn't immune you from short-term market freakouts. But like I said, there's never been a AAA rated company default on a bond. It's just a matter of how long you got to hold it before you actually come out to the good. And these do pay a dividend quite regularly. And when you adjust it for the dividend, this thing rock and rolls, baby. Rock and rolls. The dips are temporary, and we, rock and roll. There you go. So hopefully that was a interesting tidbit on the current financial happenings going on behind the scenes. It's a rule change that could affect us all. We'll see what happens. So here we are, about to push out to new all-time highs as the market opens. Creeping up closer and closer. That next resistance level sitting right there at 61.20. New all-time high happens above 61.45. Not far away. Not far away. NASDAQ already sitting up there at all-time highs. Boom. Shakalaka. Open up new highs. Can we push that one higher? Good question. Now this will basically complete the 2007 pattern. Scares the bejeezel out of me to think about this. We look at the SPX. We go to the weekly charts. If you've not seen this before, look at this, baby. Whew. This is scary stuff right here. Look at this. This is 2007, right before we took a 57% bath on the S&P 500. Look at that pattern. It's eerily the same. Eerily the same. They're never perfectly the same. We're never going to get exactly the same pattern, but that's so close. Definitely makes me think twice about what I'm doing here. Definitely. Now, we might push it on up. Could go up to 63.60 right now. That's the roadmap bounce pattern off that weekly. That's a weekly roadmap bounce right there. How high are we likely to go? 70% likely right here. And this is already kicked off. Like this thing kicked it off right back here. 75% likely. 70% likely to get up to 65, which is, right at the 66. I said 66 seems like the line to me. I've said that since back here in 2022 when we did this big pullback in the markets. 66 looked like the top. We can push it on up there, get it, and then roll over. I still think below 4 before we go above 7. We'll see what plays out. See what plays out. Still got upside to go, so I'm not in the fear. I'm not in the shorts until I'm in the shorts. So yesterday, right as I wrapped up, somebody goes, why don't we have a short on S&P? It's because S&P looks strong. Looks like we're going higher. But Russell right now, look at that. We're sitting at a resistance point. Like we're not up here. And we haven't done that. We're sitting right here. And this is not opportunity to catch up. Right? This is not gotten to close up here and set up the highly likely to pop up to that target. This is actually grinding the resistance right here. A measured bounce would be the expected move, and that might take us down to this kind of price. That's why for now, out to September, I currently have a spread looking for another dip. Now, if we get a fast correction, I'll probably book it out, wait for another pop, go out even further for the bigger drop, because I don't think this is we're not gonna get down here just in a couple weeks. It's one of those strategic type plays. I think this is going to take this correction is probably going to set up to be a bigger thing here. S5FI. Take this back off log mode. Popped up pretty good yesterday, but took it right back down. It's just chopping right here, just right under the 80% level. Maybe we pop 90. If we do, it's game on for a correction. This is stocks above their 50-day. Stocks above the 20-day. A lot of volatility yesterday. And then stocks above their 200-day, not really moving. Not really moving at all. Just kind of hanging in here. We might see this arc. And we could see a dip. And I don't know. Market gauge, not really indicating much clarity which way we're going. Although this one probably going to head back to the bottom. If we do spike the bottom, that sets us up to rally higher and get S5FI up to 90. And then when those two are topped out, well, could set up the bigger down. Especially if this one gets up to the top too. If they all three get to the top, we could definitely mark the top on the market. So, still choppy dangerous here. Chop, chop, chop. That overnight action took it back strong last night. That's interesting on the reopen. We just went on a rip right there. Not slowing down. We did tag the 15-minute roadmap line right there. Tagged it. Went on a run. Next high. Same pattern all the time. Right in the targets. We might be able to extend this on up. This is futures. Futures might extend up to 61.77 today. We've been grinding this. And we've basically tagged that 1272. We did retrace to the breakout. We're setting it up for an extension out to 61.77 right there. Beautiful. So NASDAQ looking a little more choppy. Didn't actually tag the roadmap line here on the 15-minute. We did on the 5-minute. Went a little deep. Looks like we've already probably hit the targets and retraced again. So this one might be setting up another bounce, but it's one to keep a track on. If we start below this 5-minute, got to watch the 15-minute. We get down to there, watch for the bounce. If we break through, down to the 30-minute. But this one's set up to go on up. Bigger picture, bigger bounce, bigger breakout. We are set to extend this on out to this 23,000 area up here. Doesn't mean it won't be without pullbacks and humps and bumps, but we're set to extend that on out. Clear our free breakout. Could go on even up here. But the Russell, still kind of spicy hot pepper. Downside, still very likely here. Still very likely. Be careful. That's why Russell and not S&P, not NASDAQ right now. This one at a resistance point. Hasn't been able to break through. Could very easily take a spill down and doesn't even have to drag the S&P with it. Oil sitting on the, look at that. Look at that. The more it sits right here, the more likely that next pop might be right there. Gold, probably working on this correction. Went a little higher than I thought we might, but hey, that happens. Took a little longer than, this went a little faster, and then this took a little longer to finally finish up. It's like a 1, 2, 3, 4, and 5. That 4 took longer than I would have expected, but hey, that's kind of the way this works. And starting on the next move down here. Do expect to come back down in this vicinity, right around 3160, 3170, 3180, then probably bounce back up into the 30, back near where we are right now, before we take the next accelerated move down here. So I do expect a setup like push down, retrace, and then we get a fast move down in gold right there. Bitcoin has the setup to go higher, although 3 days up does not make a new trend. Probably need some sort of 618 retrace. We are up near, we're in the vicinity where we could top out for that retrace. Once we hold that higher low, that's kind of your last buying opportunity right there before we go ripping. Probably up above 120, maybe 130, maybe 150. We'll see. We have the setup. I did kind of expect to go a little deeper, but we didn't. So 130 could be what we get. Could just go popping right up there. I would love to see the target, that 150 to 170 I've been talking about, but might come up short. So be prepared for that, especially if the S&P goes ripping out, Bitcoin goes ripping out. We could top this whole thing out. Maybe before October, like I've been thinking about. October's been kind of been my time frame. It lines up with a lot of things, but maybe we top it out earlier, August, September. I don't know. Ethereum retraced. If we break back out, this could be bullish, but very cautious here. We did get right near that 50% retrace. That could be a measured bounce setup. Could set up Ethereum to recover, but still very iffy on this chart here. Very iffy. It's going to have to do a lot of things right to go higher. This was lower highs all the way down. Not looking very strong on Ethereum. NKD, take a look in here. We're rallying up. If we can actually break out above this resistance we've had, gosh, since... So Rocket Lab stopped selling puts. That's interesting. Hey, that means I'm up. Holy bananas. Wow. Dang. So I got put 700 shares right here. And I'm up like 7 grand. That was that trade right there. I got put 700 shares. I got put 1,100 shares of that. Dang. Beautiful. Love it. Love it, love it, love it. I'll be happy to book that too. Like that's a big chunk of my account. Holy moly. Holy moly. All right. DXY. So anybody doing that, Rocket Lab's now off the table until we get a pullback. Not selling puts on Rocket Lab anymore. Downside. There we go. We got the target. We could extend it down to this trend line. It's kind of funny that got there. Got there. Apple. And boom. Still there. Still in the grind. Checking on the Mag 7 stuff, which is Magnificent 7. If you're unsure, that's the 7 biggest companies basically. Dominate the market cap. We got Microsoft, NVIDIA, Apple. Well, this is outdated because NVIDIA on the top here. NVIDIA, Microsoft, Apple, Amazon, Alphabet, Meta. And we jump down. Tesla's kind of down here. Maybe it should be Broadcom or TSMC, but it's not at this point. So Tesla's way more exciting. Lots more options to trade on Tesla than any of those other ones. Apple kind of grinding. Not great. No changes here either. First move down, potential for another move down. We're sitting at that resistance, similar to IWM. That's basically what we've got here, similar to IWM. Google, similar to IWM, we're sitting at that resistance. So what the devil is NASDAQ rallying on? This one, going on up to the targets up here, probably at 508. And this one, breaking out, probably cruising on up to 164. Right there, we finally broke that pattern right there. Oh, now the crazy thing is this could still work out. Like this doesn't invalidate this pattern being corrective. That blows people's mind that we can actually, in exuberant markets, we can actually move that on up and this still be corrective and still go down pretty violently. So still highly cautious on this bubble that is NVIDIA right now. Tesla still have this potential. First move down, potential for the second move down to a lower low in the near term and on the big picture. So we've set up this bigger potential right there. So a lot of caution for me right now. I do have shares with 330 calls sold, so this is going to be down to the wire. Do I get called away, or do I keep those shares and resell premium? I got like some ridiculous. I think it was like $30 a contract to sell against the shares for 330. Did it like, where did I do it? Like right, it was like 2 weeks back, 3 weeks, somewhere right here. I sold those like right here. $30 a contract. Yeah, ridiculous. Anyway, looking at what's moving today, I run a tool that I wrote that hunts for things moving up $2 more in the pre-market, puts it on a list. Things moving down $2 more, puts it on the list. We hunt for opportunities for the day. Looking for stuff that maybe we could take advantage of. So PTIR, AYI, not particularly speaking to me here. We're kind of in this zone. If we get the close here, this could set up the bigger upside here. But right now, 368 would be the upside, but just hitting that resistance right there. So not sure. Circle, we've come a long way, but we kind of stopped at that 270 resistance. 352 possible. We are working on a pullback. This pullback's similar in size to this pullback. Copy, paste it up here. Similar, a little bigger. Maybe we could get another extension. It's possible. If we did that, be up here at like 500. That'd be pretty ridiculous. CYN, not tradable. Probably coming back down. CoreWeave, topping out. Watch for the retrace. Could be pretty violent. LNN. That pretty much hit the targets. Watch for the retrace. PPLT. Look for that to rally on up to crazy numbers. 160, 180, possibly 200. WS. Worthington Steel. 3-wave move. Be careful here. That is a corrective resistance and can lead to a lower low. Let's take a diversion here for a minute. Nike reports earnings after the close. I think we have a bullish setup going. Now, this might dip. Entirely possible we see this dip into this support right here. And if we break down below, we could see something down in the 50 area. I have put sold right down in here. I expect it to stay above here and rally. So we'll see here on that one. MU reported earnings last night. Came in. Last night it was up like 5%, but now just kind of sitting here. If you're in MUU, might be time to consider booking because we might take another diversion back down to the roadmap line here. That's having trouble getting through this resistance over here where we gap down. Having trouble getting through. And a lot of times we see that bigger retrace there before we can pop. AMD might be topping out. Resistance right there at 150. Could pull us back down to 115. McCormick, just choppy sideways, not really indicating anything whatsoever. Lots of grind. Sezzle. Upside resistance 336. AVAV. Man, that one worked. Measured bounce. That worked on the roadmap mounts right here. This high, this low. There's the target right there, 262. Could see some resistance there, but the bigger pattern, bigger move up, took years. Fast correction down into measured bounce territory. Could set us up for 500. That doesn't mean we won't be without pullbacks, but potential to go on up there. SCCO bottomed out potentially. Looking for this to get back above this. This consolidation right here is what I'm really looking at. That resistance. We get above it, probably set for going on higher here. Copper's not been looking strong, so I'm very cautious getting long copper stuff. Marvel, this is chips, not superheroes, into the resistance zone. Very similar to Mag 7 stuff. This could see a bigger downside move off of this resistance right there. Very cautious until we get above it and break out. Doesn't have that three-wave structure on the retrace here. That indicates we found a bottom. NVIDIA. Now look how far this is lagging. NVIDIA making new highs. This one nowhere near new highs at 140. It's still significantly below that. That's like 50% upside it would have to get to make new highs to catch up. Very much caution on that one. Caution, caution, caution. INCY. Let down. This could be a... It did go very deep for a measured bounce, but it could be a measured bounce that takes us up to 100. Right up in here. Palladium, still not broken out yet. We're looking for this to get above 100 to indicate we're going on up. NKTR, ooh, that one. Dumpster fire, reverse splits. There's no bullish stocks that do reverse splits, so despite that craziness, probably going back down into the abyss. Google on the list, still on the list. And that's starting to, if we can get above this red zone, bigger potential to go on up pretty massively. I like it. NVS grinding in here, may extend to 123. Careful, it's biotech pharma. This has that first move down, second move down potential. Can go as high as 105 and still do it, because that's where we topped 1, 2, 3, 4, 5, 6, 7 times or whatever. That's a significant resistance right there at that all-time high. Yeah, all-time high. Reddit, caution, rejected off of that 618 resistance. First move down, second move down potential, just like the Mag 7s. CAMT. And that potentially is done here. Look for this to rally back up through this prior high. Set up the upside, 155. ASTI. Nope. Not trading that. Forget it. And ouch. Down 109 points. Yeah, this is what I warn about right here. Look. This first move down. First move, I didn't even get that to the bottom. First move down, retrace. Next move down. That's the kind of violence that you can get into. And this still has downside potential. And if we don't hold that, it can extend right there. That's what kind of correction you get into right there. You can be like, well, whatever. That's real estate investment right there. That's New York. New York freaking out on the Democratic nominee for mayor right there. You haven't heard that narrative? Go check it out. ASML. And getting to breakout point. We're going to have to get on up above that 877 area to convince me we're going even higher here. And I really wanted to see a pullback into support before we really pushed it down even higher. LEU might be coming back down here. ALT. Ooh, that one slammed down. SITM. Potential to come back to the roadmap line there. KTOS. Back to the roadmap line potential. 3X on Korea. That did it fly too close to the sun. Watch out. That can definitely come back down to the roadmap line. FUTU. Just not seeing much here. Back to the roadmap line possible. TDD. Probably coming on down as support. That's a 618 retrace. And if we don't hold that, could go lower low. Is not bullish, not above the roadmap line on the daily there. All right, setups for today. There's 4 of them. This one doesn't look bad. Setup 79.82 is the upside right there. This closed above the 618 yesterday. Valid entry today. Looking at the statistics though, 27 trades, 88. That's all this is basically all the things I look for here. I might consider taking this trade. That's check plus. We don't have 30, but 20, 3 trades is not going to change these numbers much. That's 88. That's above 80. Check plus, and almost above 9. Almost 90. So check plus plus, and that's above 2. So that's all the things I look for right there. Very strong potential. 79.82 on that trade. And next up, another nice one. 25 trades, 80%, 1.7. Another nice, strong one. 21.47 on the upside. LDOS. Now remember, the stop is always dollar below the low. And bigger picture, that's still got resistance right up here. This little baby correction here. That hits the target before we hit the 618 resistance on the bigger pattern. So that's another one that might work out. Right there, 164.19 is the target. And then last but not least, yum. So this has a smaller bounce in here, that high, this low, closed above 151, which is hitting the target before the 152.84 resistance there. So smaller picture. This one did not trigger the algorithm. So I would be cautious here, but still another strong one. Now we're going to hit the target right there. Small targets. Small target. Nice. All right. Bias for the day. We're going to wrap this baby up. Looks like we're going to push on out. I mean, that's kind of what I said the couple days here, is that we're going to push on higher. Push on up. We're in the target zone. Watch for the breakout. Looks like we're going to push it higher, push it to extremes, complete the 2007 pattern. Not what I wanted to see, but that was always possible. Looks like we're going on up. All right, everybody. Glad some people made out on Rocket Lab. DJT still churning in here, still working on support. RKLB back down to 36. And be careful. We might rally on higher, but I'm probably going to be stepping off. 36 was where I was going to close it out anyway. I sold 36 calls against it for tomorrow. See what happens here. Maybe I hold it. Maybe I fold it. I like it. Like I said, that'll be a big dollar amount for me. 700 shares, like 10. I think it was over $10 a share profit here. And we're dipping back below 36. We'll see where this ends up. Like, maybe I keep the shares. Maybe I can go up to 40. Right there at the 1272. If you want in on those trades, Termite Trading Lab, how you do it. JeffreyTrader.com/inquire if you want to join that. Get all the trades, all the information, all the twists and turns along the way. Links in the description. Have a great day. We'll see you again tomorrow. Do it all over.